Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the evolution of the stocks-bonds correlation.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Head of Research at Quantpedia. Today we will discuss stocks and bonds correlation. You have probably noticed that the last 1 or 2 years were significantly different compared to the last 20 years, especially regarding how the long-term bonds are behaving or how they behaved over the last 1 or 2 years. Before that, in 2010, 2008, 2011, we could use long-term bonds as a hedge against the US equities. So during the time when the US equities had a bad performance, US bonds performed usually well, or at least they didn't lose as much money as equities. All of the change in 2021 or 2022, 2022 was probably the worst year for the US long-term bonds. What changed this situation is the inflation. Once the inflation started to pick up, we had a really bad drawdown in equities. So here we have a performance chart of SPI. As you can see, during the 2022, the SPI lost around 20%, plus or minus or something between 15 and 20%, but long-term treasury was even higher. This situation is not better in year 2023, so the bonds are continuing to decline and the equities started to move up. But when there is a drawdown in equities, like from July 2023 until about November or October 2023, the US long-term bonds have the drawdown at the same time, so that they do not work as a hedge at all. The question is there something really new, or is it something that already happened in the past? We have a very nice article. It was published probably 2 weeks ago. It's called Estimating Stock Bonds Correlation from Long-Term Data. It's based on the paper from 4 authors, and they checked the empirical relationship between stock and bond returns, and they are using historical data from 1875, so it's nearly 150 years. Of course, during those 150 years, they have various monetary regimes for all the countries, etc., etc. Let's take a look on data. What are the results? The most interesting result is this one. When you take a look how behaves the 60/40 portfolio, and when you compare the correlation between 2000 and 2022, and when you simulate this correlation with the 60/40 performance, you can see that you can get more out of your buck. So the negative correlation was very good for a multi-asset portfolio, because in overall you had a lower volatility. The classical 60/40 had just the volatility over 8% or slightly over the 8%, and you could build minimum variance portfolio with a valuation less than 6%, so which was really great. But when you simulate the same portfolio with the correlation from 1970 until 1999, so which is another 20-year period, the average correlation was 0.45. With the same 60/40 portfolio had the volatility over 10%, and you were not able to get better than 7.5 or 8% volatility as a minimum variance portfolio. The correlation was really high. The bonds did not offer a really great diversification benefit for equities, and we are probably in the same regime at the moment. When you look at the stock bond correlation for the United States until around 2020, here we have the rolling correlation, and we can see that the last 20 years, from 1999 until 2020, was an anomaly. It was not something that we should expect to continue. The normal correlation between stock and bonds is positive. It was usually around 0.2 in the past 130 years before 2000. The last 20 years, from the 2000 until around 2020, were an exception. So it's not the rule, it was an exception. That's how it looked on the long data. How does it look when we compare stock and bond correlation and inflation? Here we have a chart. The chart is divided into 3 different periods. So it's from 1875 until 1913, so before the start of the World War I. Then from 1914 until 1951, so during the First World War and the Second World War. And after the Second World War, the inflation was jumping all around the chart. So we had deflation like minus 10%, and we had inflation like plus 20%. So the 150 years of the history show us that there can be really strong movements in inflation. You can have a strong deflation, also very strong inflation. It was mainly during the First War and Second World War, during those periods, and during the Great Financial Crisis in the 1940s. The other periods, the inflation is literally smaller. What we can still see, 1999 until 2020 is an exception. So this is this part of the chart. So the negative correlation with the small inflation, like just the 2%, and the negative correlation between bonds and equities is really an exception. So most of the time, the inflation is unstable, so it's not around 2%. Inflation can vary a lot, so it can go from -8 to 10% till 17%. And the stock bond correlation is not negative. There are some times when the stock bond correlation is negative, but most of the time it's a positive and it's about 0.2, 0.4, 0.5 in some cases. You cannot hope to get same hedge capabilities from the US bonds as we had in the last 20 years. It's a set fact, but we should prepare for that. And we can expect that in the next years also. Then we have another article from last year, from 2022. It's another paper. The authors of those paper are checking the stock bond correlation, and they are taking a global perspective, so they are not just looking at the US, but they are looking at other developed and also emerging market countries. What is the most important or most interesting chart is this one. I mean, it's only from 1970s, but it's showing us how the correlation between stocks and bonds changes over the time, and it plots this stock bond correlation for multiple countries. What is the most important here is that the stock bond correlation between the countries is correlated by itself. So it means when we have a high stock bond correlation in US, we have also the high stock bond correlation in Germany, Japan, UK, Canada, Australia, I mean all of the developed markets. And when we have a low correlation between stock and bonds, we have also the low correlation in US and also in Germany, UK, Japan, Canada, etc. There is no way how we can hide from this fact. The world is interconnected, so right now we have a high correlation between stocks and bonds, and we have this high correlation not just in the US but all around the world, and it will probably stay the same, so it doesn't help a lot when we go to other countries and they have the same problem. There is only one catch, and it's emerging market local currency stock bond correlation. So here we can see that here is the US correlation between stock and bonds, and here is the correlation in emerging markets. So in emerging markets, they are not so connected to developed markets. The emerging markets, they have their own problems. So what the chart is showing us is that even that in the times in 2000, 2010, when the correlation between US stocks and US bonds was negative, I mean the majority of emerging markets had the positive correlation between the stocks and the local bonds. This is probably how it usually looks like and how it looked like for the most of the history in the US. The emerging markets, they did not react in the past to changes in the US when the US had the small 2% inflation for a lot of the years and the negative correlation. They had their own problems and the correlation was nearly always positive. The question, of course, is what affects the correlation between stocks and bonds, and for stuff like that we have another paper. It's from 2019, but it's also based on a long history of the data. So the researcher Marco Pericoli sheds more light on the issue and shows that the correlation is primarily influenced by the uncertainty about the inflation and real interest rates. That's exactly what happened in 2022, 2023. So we had the surge in inflation, and right now there is great uncertainty about the inflation. In the past, we knew that the central bank was trying to get inflation to 2%, and they were successful in the last 20 years, but at the moment, who will say what will be the inflation the next year? Will it be lower than 2%, higher than 2%, very high? So there is a greater uncertainty about the inflation, about the real interest rates. It also affects the relation between stocks and bonds. That's the main reason why there is a shift. I hope that you liked the current video. It was more macroeconomic based, less about the trading strategies, but I mean, what is the correlation between stock and bonds? It really affects also the trading strategies, and it also affects the correlation inside of your portfolio among the trading strategies. So it makes sense to pay attention sometimes on these macroeconomic issues. So I hope that you liked the video. I hope that you understand the correlation between stock and bonds a little more. I really recommend these 3 articles that I picked for this video. The links for them are in the description. And I hope that you join me in the next video. So have a nice day, and do not forget to subscribe to our channel. Thank you.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.